Accounting cycle. Let's start by defining accounting and why it is important. Miller Nobles define accounting as the information system that measures business activities, processes the information into reports, and communicates the results to decision makers. This is extremely important considering that every business needs accounting, and therefore accountants. In addition, the accounting process is highly regulated in order to promote and establish a fairer and safer business environment. So in order to understand the accounting cycle, we need to consider the importance of every aspect of the cycle. Because the system of accounting is a live system, meaning it is constantly happening and changing, companies need to produce their financial statements for specific periods of time. We start by creating the first detailed records of all increases and decreases that have occurred in an individual asset, liability, or equity during a specific period. These detailed records are called accounts. The first set of accounts are the asset accounts, which are divided into tangible and intangible assets. Tangible assets include every item that the business owns or controls, like cash, accounts receivable, notes receivable, prepaid expenses, land, buildings, and furniture. Intangible assets have no physical form, like trademarks, patents, and copyrights. Liability accounts collect all the debts that the business incurred during the creation and operation of the business. For example, accounts payable, notes payable, taxes payable, salaries payable, and unearned revenue. The next set of accounts are the equity accounts, which list the owner's claims to the assets, like owner's capital, owner's withdrawals, revenues, and expenses. Once assets, liabilities, and equity accounts have been created and balances totalized, we need to remember the accounting equation. Assets equals liabilities plus equity. This is important because all the transactions must balance at any given time. By analyzing and journalizing transactions as they occur, businesses comply with several accounting principles and make their accounting process much more manageable. And this is our step 2. Some important principles are the time period concept, which assumes that business activities can be sliced into small time segments and that financial statements can be prepared for a specific period, such as month, quarter, or year. The revenue recognition principle requires companies to record revenue when it has satisfied each performance. In other words, when it has actually been earned. Finally, the matching principle ensures that all expenses are recorded when they are incurred during the period, and matches those expenses against the revenues of the period. There are 3 steps to analyzing a transaction. Step 1. Identifying the accounts and account type, asset, liability, or equity. Step 2. Decide whether each account increases or decreases. Step 3. Determine whether the accounting equation is in balance. Transactions are recorded or journalized in date order and are based on the source documents, which provides proof of the financial position of the business. Every transaction must be recorded into at least 2 accounts, and it is known as the double entry system. Every account has a debit column and a credit column. Asset accounts increase with debits and decrease with credits, while liability and equity accounts increase with credits and decrease with debits, as shown here. However, owner withdrawals and expenses increase with debits and decrease with credits. Example: buying ice cream for kids increases or debits expenses, and in this case, my owner's withdrawals account. In addition, this expense decreases or credits my cash account because I had to take some money to pay for today's ice cream. Well, some expenses are difficult to avoid, as you must have noticed in this video. This concludes the first 2 steps of the accounting cycle video. Step 1, creation and balancing accounts. And step 2, analyzing and journalizing transactions. My name is Sandra Vasquez. Thank you for watching.